NPV, ROA, EBITDA, WACC, leverage. What do these terms mean? Many people are also surprised to learn that financial statements carry a large degree of ambiguity and subjectivity. Just as English majors argue about the interpretation of a soliloquy in Hamlet, managers and accountants can disagree regarding the best measure of a company's performance or financial status. The reason for this subjectivity is that accounting statements have to be put together while much is still in process. Although we could eliminate this ambiguity if we waited until the end of the firm's life before we tallied up its profits, this information would be too late to help with decisions that have to be made while the firm is still operating. To provide more timely and useful information, accounting statements do not just look backward and tell you what happened in the past. Virtually every number on a balance sheet or income statement is based in part on estimates of what will happen in the future. Unfortunately, future cash flows and events are never known for sure. This is what opens the door for manipulation by unscrupulous management. Even well-meaning managers are often overly optimistic about their firm's future prospects. To deal with these potential problems, restrictions are placed on what kind of information about the future is permitted to be transmitted through the financial statements. Auditors and other checks and balances exist to limit management's ability to misrepresent the firm's performance. But these elements don't work perfectly, because they don't have a crystal ball into the future either. In this audiobook, you will learn how this subjectivity and judgment affects the numbers, and about what aspects of the future are incorporated and what others aren't. This will help you learn to read between the lines of financial statements and know when to be skeptical. Once you better understand accounting and finance, you will also begin to see that the numbers that your firm supplies to external parties, like shareholders or tax authorities, aren't the numbers you want to use to run your firm. And no, the reason doesn't have anything to do with cheating or misrepresentation. At a minimum, you will want more detail about the performance of the individual parts of your company than annual reports and tax returns can provide. In addition, you want data that help you predict how costs and revenues will change if you make different decisions. External reporting systems typically sort items only by their type. For example, production costs are separate from marketing costs. But you would like information within each category to help you understand how your costs behave. What costs are fixed versus variable? What costs are sunk or committed to? What costs are direct versus allocated, and so on. Finally, the reports provided to external parties like shareholders and creditors are compiled using rules that are regulated by standard-setting bodies. Note: in the United States, public companies have to file reports quarterly with the Securities and Exchange Commission, SEC, using accounting rules called Generally Accepted Accounting Principles, GAAP. These rules are established by a private sector body called the Financial Accounting Standards Board, FASB. Internationally, many companies use International Financial Reporting Standards, IFRS, which are established by the International Accounting Standards Board, IASB, headquartered in London. Some countries, similar to the United States, have their own standards. Moreover, all firms, both public and private, have to file tax returns, which require compiling financial information using the rules specified in the tax code. Endnote. Given that the company already has to compile numbers in a particular way to satisfy these external regulatory demands, many companies choose to use these exact same numbers for internal decision-making purposes also, because it's cheaper than coming up with an additional reporting system. Be careful. These rules are often designed for simplicity, to be conservative, or to achieve other objectives, not to measure your performance or financial position as accurately as possible. I will discuss some of these problems and how they can distort your performance measures. Another important reason for managers to learn accounting and finance skills is to help them become more valuable participants in discussions of corporate strategy.